Hey Renter Retires, it's Adam Schroeder here, and today we're going to talk about whether or not you should pay points on your loan. Before we get started with today's video, let me remind everybody, please subscribe to our YouTube channel and click the notifications bell so you're not missing any of the content we're putting out trying to make you the best investor you can possibly be. We really appreciate all of you who've been watching and contacting us and talking with us about real estate. We love helping you put your portfolio together, and we look forward to talking with more of you. So today we are going to talk about points when it comes to loans. What are points? Well, points are quite simply prepaid interest. And the number of points you pay is based off of your mortgage amount. So let's say you're taking out a $100,000 loan and you are told by your mortgage broker you can pay a point to lower your interest rate. Well, 1 point is equal to 1% of the loan value. So that would be $1,000. Last I checked, 1% of 100,000 is $1,000. So what is the benefit of paying points? The benefit is that you lower your interest rate overall because you're prepaying the points. And right now in today's environment, points are at a premium because lenders know, and the people buying the mortgages know, that you are likely to refinance the loan because interest rates are high now. So as interest rates come down, they're going to see a rush of people coming in to refinance, and they really want you to hold on to that loan for a while so they can make the maximum amount of money on the loan. As we all know, interest is front loaded on these loans, and so they're recouping some of the danger by charging points up front. So should you pay points, or should you pay more in down payment to get the benefit of a lower interest rate? Now, we're going to talk a little math here because, as you've discovered in the YouTube videos I've made, real estate is really just math in a lot of ways. So when it comes to paying points, the thing you need to figure out is your break-even point versus your hold time. So we talk a lot about how most investors own turnkey rehabs for 4 to 6 years on average before your principal pay down and your appreciation make a whole lot of sense to do a 1031 exchange or a cash out refi rather than continuing to hold the loan. If you're getting new construction, it's even longer than that because people aren't concerned about any CapEx expenses because everything was brand new the day they bought it. So let's go over it. Say you have a $200,000 loan and you have to pay a point to lower your interest rate by 0.25%. What you're going to do is you're going to say, okay, this point is going to cost me $2,000. How long is it going to take to pay off that point with the money I'm saving every month on my mortgage payment? So let's say it's $200,000 loan, $2,000 for points. It's going to save you $50 a month. Well, you take your $2,000, you divide it by 50, and you're going to get 40 months. The question you have to ask yourself is, how long am I holding this property? Because if you're only planning on holding this property for 3 years, it's not worth it. If you're talking about 4 years, borderline. You're only saving money for the last bit. You're only saving it for really 8 months. If you think you're going to hold it 5, 6, 7 years, then you're talking. Then you're really looking at it as whether or not it's worth it. With 8% inflation in today's world, you're paying, future dollars are worth a lot less. So maybe it's not worth it to put down way more money and really, extend the timeline where your payoff is going to be, because those dollars are going to be less than they are today. So you really got to look at your break-even point. If you get up in that 5, 6, 7 year payoff, you're really not putting yourself in a good position. You have better uses of your capital than paying points in that situation. But let's say you're getting a new construction property that you plan on holding for 10, 12 years, and you're not sure about your refinance and you're planning on holding it for a while, then maybe a 3 to 4 year payoff makes a whole lot of sense. Because worst case scenario, you're refining after 4 or 5 years and breaking even. But if you're thinking, I might hold this loan for 7, 8, 9 years before I do anything with it, then points make a whole lot of sense. So what you have to do is just some very, very simple math. You figure out how much money you have to pay to lower your interest rate. And when you lower your interest rate, how much is that lowering your payment? Divide the points by the payment to get your number of months. When you get your number of months, then you just look and see, is this a timeline that makes sense for my plan for this property? You know, if you're buying something in Cape Coral, for example, with our new construction that has a lot of built-in equity, and you know, okay, I'm not going to refinance today, I'm not going to pull cash out now, but in 2-3 years, I'm likely to pull money out because there's a lot of equity in this property, then it probably doesn't make sense to pay a lot of points. Maybe a little bit just to lock in a rate. You know, if in today's environment, the people with 20% down are having to pay points for the most part. So maybe, you know, you're paying a couple $100 in points and you make that up in a year or 2 years, something like that. But, you know, a 4, 5, 6 year payoff will not make sense because you're not going to be holding this loan at the time that your payoff period happens. So do a little bit of math, see if it makes sense. If you're not sure, contact us at renttoretirement.com. That's renttoretirement.com. You can schedule a call with us. You can see what inventory we have. We can help connect you with people. Whatever you need in your real estate portfolio, we will help you with that at renttoretirement.com. Really appreciate you joining me for this video. See you on the next one.
Thanks for watching the Rent to Retirement YouTube channel. Check out some of our other videos, like this one, or this one here.